GDP fall that happened in the last couple of months has created some amount of impact, even on the government's thinking that we can't take all this for granted. The macroeconomic parameters will start upticking, and what was a perfect storm on the wrong side will start becoming a virtuous cycle in the positive sense.
Hi and welcome to Earnings Call Preview, the show wherein we tell you with two eminent experts as to what is quarter one or what is India Inc. likely to do in the quarter one earnings. A very important quarter simply because FY13 promises to be a year when the GDP growth might not be that great, but some promises being made on reforms recently. So the earnings assume that much more significance. So yes, lots of sectors and lots of stocks to be discussed, and to do that, two very eminent experts in Nitin Rakesh of Motilal Oswal and Saurabh Mukherjee of Ambit. Need no introduction, both these gentlemen. Thanks so much for taking the time out and joining us. Nitin, a lot of brokerage reports seem to suggest that at the end of Q1, there will possibly be an earnings downgrade that would come in for the FY13 EPS. You think, one, that is that a possibility? And two, is the market pricing that in already?
I think from our perspective, we've estimated 10 to 12% Sensex EPS growth for FY13. At this point in time, we don't foresee downgrading that, so around 1250 odd EPS on the Sensex. About 15 to 16% revenue growth. Slight expansion in margins because of commodity prices easing. I think so far we're not expecting any surprises from this quarter. Even though, given that we're probably going to be closer to 5% GDP growth this quarter, it will look like that things are getting worse. But I think keep in mind that base effect will start playing up, and we probably will see a little more uptick in GDP growth for the rest of the year. So we probably will get a little more tailwind in the second half of the year as well. So from our perspective, we don't think we will need to downgrade earnings beyond where we are today.
What's the base case, Saurabh? Because a lot of commodity companies might actually not do too well. You think that will alter your expectations from FY13 as a year as a whole?
I think I agree with Nitin in that the broad tone of the result season will be not upbeat. There are disappointments there, quite large companies, prestigious companies disappointing. A broad picture is we have around 5% earnings growth for 13 on 12. I think the market is currently at around 10%, and I think a weak quarter, weak Q1 will probably push the market's earnings down towards around 5% YOY growth. The biggest disappointments, you mentioned natural resources. I think that's quite certain it'll disappoint. But I think the other areas where you'll see disappointment is banks, auto and industrials. So four large sectors: natural resources, banks, auto, industrials, which will probably give a relatively negative tenor to the quarterly earnings season.
Okay, so not too much expected out of rate sensitives probably, and the resource stocks might also not do too well. Let's talk about all of these individual sectors and some specific large caps from those pockets. We'll of course address some mid caps as well. But Nitin, let's start off in the alphabetical order. And autos, the belief generally is that barring one or two or three exceptions, broadly the performance for the auto companies might not be that spectacular. What's your sense?
Yeah, I think again, we'll probably see decent revenue growth, but potentially a little shortfall on the earnings side. And again, each case is individual. So Maruti may differ from a Tata Motors, will differ from a two-wheeler company, but I think broadly getting to 20% revenue growth is likely. And again, there are some individual competitive pressures. For example, two-wheelers is getting hyper-competitive with Honda coming in, and that's putting pressure on the existing two large players. Tata Motors is actually a global play, so it's not really a call on how things are panning out here, and it's not so much an interest rate sensitive anymore from a domestic perspective. But I think Maruti is an interesting case because they will probably benefit from the softening of petroleum prices, but at the same time, right now they're struggling with capacity on diesel. So again, it's a very individualistic call, but broadly, I think you will see some decent numbers at least from Autopack. You will see some growth.
Okay, some growth. Saurabh, what's your base case? Because again, as Nitin said, almost all of these companies will differ. It's not like IT, wherein generally you can paint them with the same brush.
That's right. I think one thing it's worth noting is I don't think the shape of this result season should be used to make major investment decisions. We're probably at a turning point in the economic cycle. I think growth is somewhere close to bottoming out, and this could well be the weakest quarter of results before the economy turns. So if you end up buying and selling stocks on the back of this quarter's results, you might not be doing yourselves a great favor. And Maruti is a classic example of that. It's a great franchise. It probably will be a weak set of numbers. My sense is they'll disappoint on the top line and they'll disappoint on the bottom line because the benefits of input cost easing off haven't yet come through meaningfully. So if you decide to stay away from Maruti just because this quarter's results are bad, you might just miss out on a great long-term franchise. I think that theme will repeat itself across several sectors. Don't take this quarter's earnings as a guide to the rest of the year or indeed the longer term. Just treat this as somewhere close to the bottom of the economic cycle where the rate sensitives are suffering a fair bit of pain, but focus on buying the quality franchises at attractive valuations.
What about, okay, so that's valuable advice, and probably we'll talk about this in other sector discussions as well, Saurabh, but what about a couple of other companies? Because a few of your peers are fairly bullish on M&M post the quarter's numbers. They believe that not just with the tractor performance, but the vehicle performance, XUV 500, for example, or a couple of others, are not being priced in. What's your sense?
I think XUV has been a remarkable success. I think it's probably will go down as one of the most successful launches in Indian history, especially in the 10 lakh plus range. Remarkable feat by Mahindra there. But Mahindra two-wheeler, Mahindra Navistar, I'm not so sure that they're out of the woods yet, and hence as a whole M&M I'm not that positively predisposed to. I'll be looking more towards Eicher Motors. I know the CV sector isn't doing too well and Eicher's numbers might be weak, but I think Eicher is a star in the making. Over the next 3 to 4 years we see Eicher as the strongest bet in the Indian auto sector. They've done a tremendous job over the last 3 years, and you've probably got the makings of a pretty formidable competitor to Tata Motors and to Ashok Leyland. So a quarter like this where Eicher might come in with weak numbers, the stock might crack after results, could be just the time to buy Eicher Motors.
Okay, so those are some specific stocks in the auto space. The other pocket that we want to talk about, and Nitin, well, again, rate sensitive, is banking. And this time around, there's a bit of a confusion because last time around most people anticipated that SBI may not do that well. And of course, it surprised a few. This time around, a lot of people are hoping for a surprise from the big boy. And we'll talk about private banks as well. But let's start off with banking in general. And if you can probably talk about SBI.
So I think the banking pack is actually, in our view, split into 3 groups. The private sector banks, the PSU banks, and SBI. So I think the way to look at it really is what happens to each of these 3 packs. I think the private sector banks probably are the best placed. They'll see healthy top line growth and healthy profit growth. I wouldn't be surprised if we see 25% profitability growth from private sector banks. Obviously, there'll be cases that will be above or beyond, but I think 20 to 25 is the range that you'll expect from them. Potentially, you will see 18% top line growth from the banking sector in general, but PSU banks will probably be in the 10-12% range. So I think the real joker in the pack is what happens to the SBI earnings, given that we actually had sequentially, year on year, we had a pretty weak quarter last year because you still had quote-unquote cleaning up going on. So you may actually see a 200% jump in earnings on SBI, and that will actually skew the whole banking earnings. So I think the way to look at really is ex-SBI and ex-PSUs and ex-private. So you can actually break it into 3 packs and then take your calls.
What's the call, Saurabh? I mean, SBI masks the disappointment in the PSU space, if you believe there would be disappointment.
I think asset quality for us remains a challenge in the banking sector. We also have very good reasons to believe the RBI won't cut either in July or in August. So the earliest rate cut, and even that is doubtful, is October. So to the extent that you're really not going to see meaningful rate cuts going forward, and asset quality remains a pretty meaningful challenge. Something like 10% of assets outstanding in the Indian financial system are either getting restructured or they're already NPA'd. Now the banks can mask that in their results by restructuring it in post-rate earnings, SBI and others, but it necessarily won't translate into a buy signal. If you do want to buy banks because there's a potential cyclical recovery coming through, then I would look down to someone like a Kotak, and amongst the PSUs look at something like a Bank of Baroda. Kotak has avoided the whole power infrastructure asset quality challenge, and Bob arguably has got the best asset quality amongst the PSU pack. We remain circumspect on SBI's asset quality. I think there's much more weakness there, which will gradually emerge as the year unfolds in SBI's case.
Your top result recommendation on the PSU side, because those numbers were very skewed last quarter.
I think Bob remains our best bet in the PSU sector at 1.1 odd times price to book. We see Bob as well placed, especially given that it's the best asset quality mix amongst the PSUs. In SBI's case, I think the CMD has gone on record saying that asset quality will improve this point in. We're not so sure about that just yet.
Okay, so that's two strong sectors, the markets as a whole. Our guests are fairly okay with the kind of performance that autos and banking may post. Selectively, stocks may underperform or outperform. Lots more to talk about. Some energy stocks, talk about pharma, export-oriented themes, IT, all of that coming up in just moments from now on Earnings Call Preview. Don't go anywhere.
This show brought to you by technology that touches lives.
Maximize the mid-cap advantage with India's top-notch technical analysts Deepak Mohani and Prakash Gaba. Trade at a profit, whether bears or bulls are in charge. Only on ET Now.
Good morning, Rahul.
Morning.
You look fit, but is your mouth healthy?
Yes, of course.
But healthy mouth is free from germ buildup. Let's check. This is germ buildup.
But I just brushed.
Try new Colgate Total. It helps reduce germ buildup up to 90% and works for 12 hours. Have you been using Colgate Total?
Yes, every day.
Now your mouth looks healthy.
Wow, much less germs.
Colgate Total, 12-hour protection for a healthy mouth.
Okay, welcome back to Earnings Call Preview. Now time to talk about or take stock of some of the real heavyweight sectors and specific stocks as well within those pockets. Let's start off with the export-oriented themes and IT. You think that this time around the street could be disappointed? Is there any room for disappointment or a positive surprise? Because everybody believes that HCL Tech and TCS will do well, Infy and Wipro will not, and some specific mid-caps will do what they have been doing. Hexaware, for example.
I think IT is again a case where you'll see great rupee earnings growth and revenue growth because currency impact will play out. But I think on a dollar-to-dollar basis, QOQ might look a lot worse than people expect, purely because I think the global environment's been fairly harsh. So I won't be surprised. I mean, if companies like Cognizant have actually muted expectations from the street twice over in the last 6 months, then I think there is definitely room for downside surprises. And I don't think everything is in the price yet. So if we get downgrade on earnings from Infosys, for example, that might actually lead to a negative surprise for the market.
Nitin, and that's the key point. You think more important than what they deliver in Q1 would be the commentary that comes in from the companies, because till now it's been fairly subdued, but it's not been negative. You think that could probably dampen the spirits, if at all?
I think so, and I think Infosys especially has been burnt badly in the last couple of quarters with the kind of commentary they've given out, and the market is looking for some more signals. And obviously, last quarter there was talk about Infosys having, stopping all consensus or all earning estimate to the street. But I don't think that's going to happen. But definitely, earning commentary is going to be more important than what they actually deliver.
Saurabh, could there be a positive surprise? People believe 3%, 3.5% for HCL Tech, almost 3% for TCS, and not too much positive from an Infy or a Wipro.
I think what's becoming very clear is in Indian IT, there's a right business model and there's a wrong business model. It's also clear that two of the large four have the wrong business model, Infy and Wipro, and two of the big four have managed to get the business model right, which is TCS and HCL Tech. What Accenture's results last week show is that if you get the business model right, there is growth out there. There's growth in offshoring, there's growth in IT outsourcing, and I think Infosys has missed that wave. They're still very focused on application development and maintenance. HCL Tech and TCS, perhaps with a bit of luck, with a bit of serendipity, HCL Tech's Axon acquisition was a stroke of genius or luck, how we look at it. I think HCL Tech and TCS will continue posting decent numbers. The other two will continue posting negative surprises, especially on the guidance.
Anything that you guys as a house are watching out in mid-cap IT, because there are a couple of largest mid-cap IT companies there?
I think the space that is becoming quite interesting is industrial automation and Indian IT companies, smaller Indian IT companies, which can help with industrial automation. So KPIT Cummins looks like a quite promising company from that perspective. It's a small company, it's done well over the last few years, but industrial automation, I think India could become a global hub in this, and KPIT Cummins looks like a very interesting play in that area.
Okay. The other export-oriented theme, actually I'll stick to that right now before we come up to other heavyweights, is pharma. And Nitin, I mean, that sector really hasn't disappointed per se. Sure enough, there could be one or two embarrassing moments for some of the companies, but otherwise, generally, they've posted some good numbers. You think that will continue?
Yeah, I think so. I think it'll probably be one of the brighter spots in the earnings season. 30-odd% top line growth, 20 to 25% earnings growth again. There'll be some better, some not so good. But I think there are names like Lupin out there that are actually, expectations are fairly high, and I think they should probably deliver on some of those numbers. And I think